Okay, welcome everybody to the Prospera Energy June investor conference call. Uh, we're getting ready here for our sixth iteration of the conference call here. We've gone back and forth here between a few different topics. An exciting one today. Anybody on the Twitter space that would like to join us for the visuals, the Zoom link is in our last news release, and you're welcome to join us for the slides here as well. This will be recorded, so anybody that misses this or misses a portion of it can watch it on our YouTube here after the fact as well. And with that, we will get started. So, again, discussing the case for oil and the case for Prospera as we have been for the past few months. Some exciting updates to share today. And then we'll get into the recently launched financing that was announced yesterday morning as well. And as with all of these, there is a forward-looking statements that will be discussed in this presentation. Please take them as such. So talking about the Prospera story, where we've been, what we've done, and what we need to do now in order to continue the growth profile of the corporation. Number one, how we got here, the legacy, a Calgary-based heavy oil producer with three core heavy oil fields, Cuthbert, Luseland, and Harts Hill, with 380 million barrels of oil in place, with 8% recovered with legacy vertical well technology. Ever since the company acquired these assets back many years ago, it was stuck with lower oil price, lots of liabilities, lots of standing wellbores that were not active, an accounts payable burden, and some JV partners that were stuck in the corporation, not allowing the corporation to breathe freely and move forward. Since the new management team has come around in October 31st, 2024, there's been 18 to 20 months now of transformational execution. We have completed 17 reactivation projects, with more completed this year. The water flood has been optimized. We've had engines that have been replaced, insulations added. We've acquired all our joint venture partners to now be 100% owners of the three core heavy oil properties, cleared up accounts payable burdens, rebuilt relationships with landowners and with our key service providers. And that's shown up in the results with Luseland producing at a 8-year production high now, the reactivation engine working, us ready for the next 40 wells that we're going to be going on, and May 2026 being the highest revenue and cash flow for the company ever. So looking forward to build on that momentum here as we go and getting ready for our next chapter. We have proven out the reactivation strategy. The corporation still has certain burdens that doesn't allow us to fully move forward at the pace and speed that we would like to develop our pools at. And the offering that we have today that we'll be discussing is structured to do exactly that, get us right-sized and move forward with pace without the constraints that we've been operating in over the last few months, some of which have been some of the lowest oil price months that we've seen over the past 5 years. So successfully navigated through those tough times, got to this side, and now looking forward to proceed from here. Issues that we need to solve, efficiently increase production to add reserves value. So continue the engineered reactivation program at a faster pace. This program has ebbed and flowed. We have had to be patient with some of the wells that we brought online and really ensuring that those wells are panning out before we start the next phase. Also ensuring that we have our production excuse me, production engineering techniques figured out. So we didn't just want to go bam, 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 get all these wells online and then figured out, oh, well, we should have ran this kind of pump or we should have put anodes in the well. So really an iterative process, learning from the first few wells, iterating the next few wells, and then thereon and thereafter. We are now relatively quite confident in our strategy that we figured out 13 series pumps or above, no more than 5 RPM speed ups, start the wells off slow. We don't need velocity to carry sand. We need that raw sand to actually come into the oil and get absorbed, running the recycle pump strategy. So lots of learnings and growth through that process. Number two is dealing with the debt. So refinancing and right-sizing the capital structure. There have been numerous accounts payable on the corporation that our management team inherited. We have successfully negotiated over 150 vendors and either shares to debt conversions or payments to them over a period of time to get them fully settled up. and allow them to come back as a valued service provider to us. So after their pre-existing debts are cleared up, we start with cash payments for their business, and in some cases have built up new credit lines now that we're making payments on. So it is a slow as you go process. There is no way to accelerate these kinds of things. We just have to be patient and build while our wells continue to grow. One of the interesting things we'll talk about here, some of the investors know this, is we have a negative decline rate. So as we reactivate these wells, we're producing them very slowly. And as that sand clears up, we're able to increase those wells rather than them declining, they're inclining. And I'll show various examples of this now as we go. And number three is reduce the accounts payable. We've talked about this. Continue working with some of our core service providers, continue working with some of the legacy AP vendors to continue to get these off the books so that we can proceed forward in a more reasonable fashion without A, the cash going out, but also B, the time that it takes to build these relationships and mend these relationships. So now that a lot of time has been spent, we're able to focus more on the company itself and moving forward initiatives that can add value to the equity and to the business itself. A little recap here. So our three core properties, Western Canadian heavy oil, 380 million barrels of combined OOIP, 8 to 10% recovery factor, with certain sections that we've reactivated in Luseland at less than 3% recovery factor. So huge amounts of oil in the ground. Analogous pools next to us have recovered upwards of 40% of the oil in the ground. So we have clear line of sight to where we need to be, not just with the reactivations, but then with enhanced oil recovery on top of that. Our 2P and PV10 has now gone from 159 million at the end of 2024 to north of 200 million at the end of 2025. And I remind investors that was at a very low oil price strip that the reserve auditors used on December 31st, 2025. $11,000 per BOE capital efficiency, which is about 3 to 5 times cheaper than new drilling, and with a way longer reserve life. These wells will produce for the next 20 to 40 years at the rates that they do. So Luseland, our growth engine, again, 100% working interest, 140 plus reactivation candidates. And as you can see there, 8% recovery, less than 3% in certain places, and 2P and PV10 of about 22 million right now, expected to rise materially as we not only bring further wells online, but as the 2025 reactivations, A, continue to rise, and B, get more respect from the reserve auditors for their long life repeatability kind of production profiles. And exceptional rock, 2 Darcy permeability, upwards of 4 Darcy, 33% plus porosity. And we've demonstrated success here. We've grown production more than 300% in the last 18 months from about that 55 barrels a day to about 250 barrels a day. So almost a 5x now that we're approaching. And certain wells are looking very exciting, as I'll share here over the next few minutes. 8-year production high. We expect to hit a multi-decade production highs here as we continue to go. Cuthbert, our low decline waterflood cash engine, about 9% RF. The 2P and PV10, about 85 million. So lots of oil in the ground here still to recover on the waterflood. Nice 14 API to 17 API oil with 1 Darcy rock. Active waterflood support. And we've upgraded the water plant here massively. So lots of money spent on the injection pumps, the free water knockout, the insulation, some of the injection wells. We redid all the fire extinguishers and the safety kits. The chemical programs have been looked after, and we've done additional projects like horizontal wells with heel perfs to prove out additional candidates for optimization and remediation in our current pool. Hartshill as well, our low decline water flood, a bit of a smaller pool with 54 million of 2P and PV10, 10% recovery factor, very established pool, a very modern central processing facility that was built by Nexen, set to expand this as needed, a polymer flood candidate as well. And we've completed a 3D seismic reinterpretation along with many, many horizontal drilling locations that remain here in multi-stack pay. So not just the Bakken pool, but also Sparky and also the Wasika and the Rex, which we're active in. So production graph here of the Luseland pool. You can see here starting off at about that 60 BOEs per day, 57 barrels oil, and now all the way up to 250 barrels per day. And One of the things I want to mention is that we have completed almost no reactivations in the last 7 or 8 months, and yet production is rising and stabilized. We are not seeing a decline rate. We're seeing certain wells continue to rise, and we're barely spending money on flush buys, pressure trucks, vac trucks. A big kudos to our engineering and field operations team for a fantastic job here. And again, one of the reasons we can do that is because we're not pushing these wells to their max limit. We're only pushing these wells to where we know we can run them reliably, letting that sand come in over a period of time, recycling that oil, carrying that sand up, opening up the perfs and well bores, and then we go in and add 5 RPM at a time, keeping that production profile very flatlined. And now looking forward to see this rise here upwards onto 300 barrels plus as the rest of the summer continues. Our Cuthbert pool here, which as you can see in 2024, when we came in, suffered from massive power outages, long spikes of lost production. We've had it more stabilized now over the last year. And then during this time, we suffered from a VFD failure that we've recovered very strongly from now in this June timeframe. So back up to that 60 cubes a day mark, and looking forward to continue to see this rise as we go. Stable, steady cash flow out of this pool. We have, yes, dealt with some major issues due to the lack of maintenance that was performed in this pool over the last few years. And we've had to come in and spend some time understanding the issues, fixing the issues, and then also allowing for that water flood to respond to those once we fix the issues. Hartsill here, a pool that we targeted very heavily right off the bat, did many workovers, got it up to 30 plus cubes per day of oil. Since then, we've seen some water flood declines, as well as smaller wells that have gone down, and then saw the recovery here from March onwards that we're now stabilizing at. Hartsill is a pool where we do have lots of workover potential, but also we see more ability right now to put money into loose land and get that pool going, producing stable cash flow versus some of the higher cost Hartsill wells due to the water injection system required there. So some of the wells we'll talk about now, the key wells, we have our loose land 10 of 7. This was our steady eddy well that produced very nicely. Flow line to the battery as well, so no trucking cost here. We're able to deliver barrels directly to our 2 of 18 loose land battery. It had gone down for a workover in that March period, rebounded very quickly, and now we're starting to see, after a period of stability, bringing it back up to that 30 barrels per day of oil production. I will remind investors that our latest key wells report just got published this morning. So investors that are looking for that latest data can download a copy of that key wells report from the bottom of the homepage on our website. The 10 of 8 well continues to chug. One of the ones we've talked about with this sort of negative decline rate phenomenon came on about 10 barrels a day. I believe last time we presented, it was doing about 22 barrels a day, and now steadily at that 24 barrels a day. So slow, steady growth. Every incremental barrel is more or less free cash flow to us. Other than the trucking cost, we're not spending any more money on it. The well just continues to go, and we still are maintaining nice fluid level on this well in order to keep it going here as the rest of the summer continues. 1 of 17 well, another one of our very steady eddy producers. You can see here it has now produced for more than a year with only 1 day of downtime there. So one of the early winter days there where it had gone down for a whole day. Other than that, we are not seeing any flush by work. We're not seeing any downtime work. Seeing that nice steady 10 to 12 to 15 barrels a day. I believe this well has now crossed the 5,000, maybe almost 6,000 barrels cumulative production since reactivation threshold, and we'll continue to see this well produce very strongly. Section 17, some of these wells have been producing for upwards of 55 years straight, and we see them still producing 8, 10, 12 barrels a day, which drives credibility in our strategy that once we bring some of these wells that have been down for 20 years back, they will produce for the next 20 to 40 years at these rates, which are very profitable, very high net back. 16 of 7, the well that we're very proud of, came on quite slow, very high water cut. And most recently now, this well has achieved almost 50 barrels per day of production. This is one that we've been highlighting now for 6 months at our conference calls. Investors that are curious about this well can go back, listen to the January, February conference calls. when this well had first achieved 30 barrels per day. And we mentioned about the upside that this well still has. While on the May conference call, we showed it making 40 barrels per day, and now it has achieved a new high of 48.5 barrels per day about 3 or 4 days ago here. So exceptional. We spent, just to put things in context, we spent about $99,800 to bring this well back online, so less than 100K, and it's producing now almost 45, 46 barrels per day steady. That puts us as about $2,200-$2,300 per flowing barrel on the profitability, or sorry, on the capital efficiency of this well, which at today's pricing would put payback at roughly every 45 days, that this well would pay back its cost of reactivation, meaning it has paid back multiple times already, thus funding the next set of reactivations as it continues to go. And I will say this again today, this well still has continued upside here as that water cut comes down and as we continue to optimize this well. Again, a very patient strategy. We have to be patient. If we pull too hard on the well, it can either sand in or the water can cone in from the reservoir, and we can water the well out. So we're being very, very cautious on this well. And as you can see, that patience and caution has paid off very strongly here. The next well we'll talk about is our 3 of 9 well, another one that's very, very strong here. Very solid production profile. This one does have increased capacity here. We did install a recycle pump when this well was brought back online. And as you can see again here, very little for downtime. We're seeing strong, reliable production that continues to go. I believe this here was an engine failure, nothing to do with the downhole components of the well. And we're continuing to watch this well. It is still producing at pretty high sand cuts with the recycle pump strategy active. So we'll just continue watching it and expecting to show increased highs here as we continue on. This well has a relatively low overall cumulative production on it. So looking to really get this well moving here as the rest of the summer continues, while taking care of the fluid level and sand cuts as we go. And with that, I will pass it on to our CFO, Chris Lutke.
Thank you, Shubham. Thanks everybody for tuning into the conference call today. As many of you are aware, there was a press release that was put out yesterday that identified a $12 million equity financing that Prospera is currently targeting, that will lead to essentially a full transformation of the business. We've got a significant amount of reserves and remaining reserves in place. And for the last 3 to 5 years, the company's been undercapitalized, so it hasn't been able to realize the full potential in terms of its production and cash flow in an effort to monetize those reserves. So this $12 million financing not only allows the company to increase cash flow significantly, it increases production over a 3-year basis, which has been modeled out to over 3,000 barrels per day, and with the majority of that money, approximately 10 million of the 12 going into the ground. And so this $12 million equity placement is set to not only increase production cash flow, but retire sub-debt, settle outstanding accounts payable, and fund a workover and reactivation program on the existing wells, targeting a 4.3 times investment return at the end of the period. So this investment return is based on a comparative analysis that we've looked at with some of the peers, namely Hemisphere, and the transition that they work through. As I mentioned, sub-debt and GOR royalties are being eliminated over this period of time, $10 million being settled within 24 months of closing. Senior debt is being refinanced with various options. We've got some slides on the refinance optionality and the reserve growth through this plan that we'll talk about here as well. AP is being reduced from what was over $16 million in Q1 of 2026 to just over $5 million by December 31, 2028. The company is focused on a disciplined capital efficiency of 11,000 per BOE per day, and as Shubham mentioned, we're seeing rates, capital efficiencies that are actually a lot more attractive than that. This capital plan is fully funded for the next 3 years, and does include some exercise of warrants in the 2027 and 2028 period that bolster that as well. Next slide there, Shabam. Okay, so a little bit about the deal structure and the use of proceeds. This deal structure is a $12 million total gross proceeds, as I mentioned, at a unit price of 4 cents. The shares being issued are 300 million common shares. So there's 300 million common units being issued. So it's 1 share and 1 warrant that's being issued. The warrant strike price is 6 cents over a 2-year period, so it would expire roughly June 2028. And the full dilution proceeds that would come from both the unit purchase and the warrant exercise, $30 million. As many are aware, the company's traded on the venture exchange, and we're looking at an expected closing in the July timeframe. So the use of proceeds here I mentioned already, it's very focused on putting this money into the ground and increasing the production and the cash flow to be able to address the rest of the balance sheet. The well reactivation program is $9 million. There's $1 million of existing workovers and optimizations that are being targeted. So that's the 10 that we see going into the ground by the end of 2026. With $2 million allocated to AP reduction, subordinate to be able to address some of the subordinated debt and GOR items that we're working to reduce, and working capital efforts as well. A little bit more on the use of proceeds. I think this is kind of more of the same, to be honest. The well reactivation program and the optimization split of 9 and $1 million, and the AP work reduction, working capital, and subordinated debt being reduced by $2 million. We've got some more slides on this a little bit later on that shows the transition of this. A lot of questions that we get are why now and why this magnitude? And the reality of it is that we're seeing a convergence of tailwinds. We're seeing, a strategy that's working and that we're looking to further scale. This strategy has shown that we can increase loose land production by over 300%. We've been able to continuously increase these wells, and as we become more and more confident on these wells and less risk averse, we're able to increase the production and take on more of that sand, and so are continually seeing additional amounts. We've got 41 wells that are already engineered in the loose land field for reactivation, and there's approximately 140 across the core assets that we're targeting. 19 reactivations have already worked since November 2024. And so we're seeing attractive paybacks at the current prices. And of course, an 8-year production high that Shabam mentioned earlier. Why now? We're seeing a very attractive commodity price window here. A stabilization of prices has over the last 2 weeks has stabilized around $70 WTI. With attractive US to Canadian exchange rates, which are allowing, which we're seeing Canadian WCS pricing in the low to mid 80s, which is producing very attractive netbacks across these core assets. So as many are aware, the Strait of Hormuz disruption has led to price increase from earlier this year. We're seeing normalization or stabilization on the WCS WTI differential, about $15 a barrel, and that's a little bit lower in the summertime than it is obviously in the winter. And as a heavy oil producer, we're leveraged significantly by these higher oil prices. Equity windows we see as very episodic. This is a one-time opportunity, or this window may not be open forever, and so this is a little bit of the rationale around the why now. What's important to take into consideration is that this raise fully transformed what is a constrained balance sheet. We're in a situation where because of accounts payable arrears and some of the debt that has been inherited by the current management team has left the company in a situation where liquidity continually comes up as an issue. There's a bit of going concern issue that's been addressed. This $12 million fully addresses that throughout the 3-year plan. So this slide here shows a little bit about the historical performance and where we see the 3-year plan headed. As you can see, production has been sub 1,000, since beginning of 2025. The field netbacks have been approximately $15 a barrel, so still positive, but not yet optimized, and carrying a high amount of fixed operating cost per barrel. And operating expenses in the $40 to $45 range. And so we see with the incremental production that's being added specifically at the end of 2026 and through 2027, that the netbacks are increasing to $30, $35 a barrel. Operating expenses are coming in and targeting sub $30 a barrel through that period of time, which is on par with other peers that we're looking at with similar type oil reservoir. Here's another slide on production adds through the period. You can see our base production staying relatively flat around the 800 barrels a day, 750 to 800 barrels. But the added production through this workover and reactivation is very meaningful. So we're targeting an exit production rate at the end of 2028 of over 3,000 barrels, with the majority of those barrels being added through 2026 and 2027. The balance sheet cleanup and reorganization is a significant shift in the financial health of the company. So there's multiple items that we're targeting through this period of time. And so you can see the before and after picture in the top two windows. And then down below, you can see the subordinated debt runoff that we're targeting. So to start, we're looking at entering into, or we're in the process of renegotiating and refinancing the senior debt. There's a couple of options that we've got available, one being an extension that we're targeting, the other being an extension with a buyout at the end of that period. The GOR royalty burden, the convertible debt, the promissory note, and the preferred shares are what we call subordinated debt, so all subordinated to that senior debt. And those are items that we're looking to fully remove over 24 months as part of this plan. So you can see in the subordinated debt runoff, there's a current amount of roughly about $6 million of subordinated debt, which doesn't include the royalty amount, but that is fully extinguished by Q3 2028 through capitalization and payment plan. This slide shows a net debt that's been modeled out over the 3-year period. And so you can see that we're continuing to hold the debt position with the senior debt. But as we get into the later 2027 and early 2028 periods, that starts to come down considerably. So through the execution of this plan, we do expect to see that the share price increases and starts to reflect the value that's been created of the production and cash flow increases. And as we approach end of 2027 and beginning of 2028, that the warrants that are outstanding and associated with this raise are being exercised. And that really starts to impact and improve the cash position. So we see a negative debt, net debt position which is a positive cash balance of approximately $25 million at the end of the plan. This slide really speaks to the accounts payable reduction over time. So we're targeting $5 million at the end of the plan with a slow transition as we move through and address each and every vendor there. We started at the beginning of November 2024 with almost 500 vendors with outstanding payables. The current team has been able to address approximately 150 of those outstanding balances. We expect this work to continue. So this is not there's nothing new. We're not starting a program here. We're actually continuing what we've started 20 months ago, and full props to the team who's worked diligently, many phone calls, many negotiations here, working closely with our current vendors. And one of the things that I'd like to highlight here is a lot of the vendors that we've worked with have entered into shares for debt settlements, and what that really does is, okay, sure, there's a financial impact to that. There's a reduction to payable that we see and will continue to see, but what it does is it also sets up relationships for the next 3 to 5 years. And so when we've got vendors that have taken shares and worked with us on a longer term or worked with us on a longer term settlement plan, those relationships hold, and we can, those are the folks we want to continue to do business with over time. And so we've got a 40-year reserve life on these core assets. And what we're really doing here through this process is we're setting up relationships between ourselves and vendors for that period of time. So this slide speaks to the CUME program payout. So what it takes into consideration is the $10 million that's going to be spent in 2026, at the end of 2026. And so as you can see here, the production that's added, the cash flow that's associated with this production add, we're looking at about a nine month payout. And so this assumes about a $75 WTI price, which is relatively close to where we're at. Some of the items in here, 12-month cash recycle 1.6 times, which is attractive for heavy oil. Year-end exit rate for 2026, about 1,500 barrels. And so we're looking to add about almost 700 BOEs through the 2026 program that we would begin to execute in the July-August timeframe. In fact, we have a rig that's currently active, and what we're looking to do is accelerate it through this capital deployment. Okay, so this ties us back to the cash, the investment return. And so when we look at what does this mean? So for every dollar that's invested into the program, what does that mean back to the investor? And so we look out at industry comparables and comps for analog reservoirs and companies with balance sheets that we aspire to look like. So Hemisphere, obviously being a bit of a darling in the industry, trades at a 5 times enterprise value over debt adjusted cash flow, and so we see that comp in the industry, and we look at about how Prospera can aspire to look like that. And so there's another slide on this we'll talk about here next that'll show how we value ourselves relative to Hemisphere, but effectively we're targeting a 4 times EV over DACF metric in the 3-year period of time. And so what does that mean? And so we need to take into consideration what does the DACF look like at the end of 2028. And based on the modeling work we've looked at, it shows about a $38 million DACF at the end of the period. And so that equates to that plus a net cash position that we looked at earlier of 25 million equates to about 175 million dollar implied equity value. And so based on the funds that are being invested, their relative position or percentage as part of the overall shares outstanding, we see, or we're projecting a multiple on investment of capital, which is this base case MOIC, the bottom middle window that we're seeing of about 4.3 times. There's some sensitivities that we've ran and looked at here that we'll get into a little bit later. That assumes a 75 WTI US barrel over the next 2 years, with some upside potential and about 5.5 million at a higher price deck if those were to be realized. Shaban, if you want to shift to the next slide. This is a bit more of a deeper dive comparison as we're benchmarking ourselves to sector's quality peer. So Hemisphere, as I mentioned, trading at about 5 times EV over DAC-F. And why is this the right comparison? Is the question here. Okay, so it's same commodity, 99% heavy oil, same type of recovery, water flood pools, same reservoir, mature, low decline. The difference in terms of Prospera versus Hemisphere is that Hemisphere is got some enhanced oil recoveries, whereas Prospera is focused on primary and secondary, with enhanced oil recovery potential in the long run. But so methodology of the evaluation here, so looking at a peer multiple but discounted from where Prospera is today. So yes, Hemisphere is trading at 5, but we need to adjust that down. We need to take into consideration that there's some heightened leverage that's involved in Prospera's story with the senior debt, less of a track record, but still with proven strategy of reactivating wells, and of course the liquidity that Prospera is working through as the balance sheet transformation is taking place. So we're targeting a 4 times EV over DAC-F multiple at the end of the 2028 period, and you can see how we're getting there, which I talked through on the previous slide, getting to that $175 equity value, or roughly about 13 cents per share target share value at the end of that period. A lot going on this slide here as well, but it's the same data. We're looking at base case $75 per barrel, equating to an investment return of about 4.3%. We've done some sensitivity work on the upside, and you can see what those numbers look like, and then really stress tested against a high confidence scenario of $70 a barrel of about 2.9 or 3 investment return. We're seeing that we're still able to meet the same production profile in a 70 or under sub $70 WTI scenario. What we're seeing is that capital is deployed a little bit longer over the 3-year period. So there's a little bit less capital deployed in 2026 and 2027, and some of that flowing over into 2028, but essentially seeing a very similar modeled case in that scenario. This is the slide that for me really brings this entire transformation home, and it's worth spending a little bit of time on. So the headline here being from restructuring to resilience. We want to set this business up so that we're sustainable in a $60 oil environment, if that's what we end up seeing, or sub $60 on going forward. And so some of the transitions that are important for that, the equity position. So we've been asked a question: how are you improving or moving your equity position from negative to positive? And so through this process, through positive net income, through exercise of warrants through $12 million equity financing, we're moving from a negative equity position of about 8.3 million to something significantly higher at the end of the 2028 period. We talked about this in a couple of slides, trade payables, so improving the liquidity, getting rid of the going concern issue in the balance sheet is paramount for us. Moving from a payable situation of $16.7 million to $5 million is a considerable reduction that we see as being very important to the health of the business. The subordinated debt, we see the subordinated debt being fully settled in the 24-month period at the the $75 million or sorry, the $75 WTI scenario, our base case. And obviously the cash balance is increasing considerably. So, relatively unhealthy position to very attractive position at the end of the period. Shabam, I think you've got a couple more slides there on reserves.
Yeah, thank you, Chris, for that very detailed information. I think it's important that as we launch this pretty transformational raise here, on which we've had some very detailed discussions with sophisticated investment banks and wealth advisors, we needed to up our game on the presentation material and the quality of slides that are being uh, presented to. So really excited to share some of those slides with our investors here in this June conference call. So talking a little bit about the forward projections, what does the $10 million program do for our reserves? I remind investors that reserves are our lending capacity, the ability for the company to raise additional debt instruments and/or refinance the current debt instruments relies on some of our PDP valuations, which were released in April there for year-end 2025. So of the 10 million, there's 92 activities as part of that. A $28 million PDP NPV 10 addition. So a 2.8x return in terms of the PDP reserve values that are being added. There's 73 reactivations there, about that $120,000-$130,000 per well that's been discussed in the past, and about 19 workovers, which are about that $50,000 per job that have also been discussed before and have been field tested. This isn't us saying that we're gonna do these. It's we have done more than 60 projects already since October 31st, 2024. And I just want to talk about the reserves category for a second here. So about half of the capex is going to PDNP wells. So these are wells that are adjacent to wells that are currently active, where the reserve auditors are saying, yes, these are proved, developed, but non-producing wells. And so once these wells come active, they go straight into the PDP category and grow that. But about 4.8 million of this 10 million capex is on the NRA, no reserves associated part of the pool, because of a period of no production, no adjacent production. These wells have entered into just completely no reserves associated with them at all, which means they stay on a reserves profile as simply liabilities. And our plan has been through 2025 to bring certain wells like this back online, that allows us to show to the reserve auditors that yes, there is oil still here. We just need to get them to agree to that. So as we bring some of these wells online, you're going to see wells converted from straight liability to actually coming onto the stack and also bringing on additional PDNP reserves. So if we bring on a well that's an NRA and it's got 3 or 4 more NRAs around it, while at the end of 2026, those will get converted also to PDNP because of the success of the one reactivation of the NRA. So the reserves profile is really very important here, not just production and cash flow, but showing to the market that these are long life reserves, having a sophisticated reserves auditor like Sproul agree to that, and then show us this long life reserve additions. Of the field mix, about 67% of the equity financing will be spent in loose land. About 1 million will be spent in Cuthbert. We do plan to reactivate our Brooks wells, which were shut in that January-February timeframe when oil pricing was very low. And then there's some small component going into Harts Hill. We do plan to capitalize Harts Hill from the cash flow that we will be growing here at a future point in time. That pool just needs a bit of a more water flood enhancements, whereas loose land is single well batteries that can be worked on one at a time. So really looking forward to show this reserves growth at the end of 2026. And going a bit further into the 3-year plan, so we talked about the PDP increases in 2026. In 2027, we're able to take the cash flow from the increased barrels we will be exiting the year at, and spend an additional 18 million of capex to add 39 million more PDP. And I remind investors, we are paying for these wells already. There's a fixed cost on the balance sheet that we carry: property taxes, surface rights, mineral rights, weed spraying, snow plowing. We're already paying for a lot of these wells that sit on our balance sheet, and to bring them back online adds barrels at a very, very high cash flow metric. And then you get the PDP increase of 2.17x in year two, and then about 1.82. You can see 2028, the capex really tails off. We are not going to just grow for the sake of growing and start doing all kinds of wastage activities. We're going to hold production flat there and just harvest cash flow, which results in that net cash position going up to about that $25 million mark that Chris was mentioning. So this allows us to have a reserves-based lending capacity that is way higher. It allows us to extend our current debt with strong collateral terms, and it allows us to attract new lenders and bring more interest into the equity stack by having this optionality through the reserve growth that we will be proceeding on here. And with that, back to our main slide here, the investment opportunity again at a glance. We've spent time in 2025 proving out the strategy. We're now seeing certain of those key wells continue to rise 8, 10, 12 months after reactivation. These wells aren't your typical well where they come on at a max IP rate and then they decline over time. These wells come on at a nice steady rate. They create cash flow and then they continue rising over time. And we really want to demonstrate that through the key wells report that's been put on the website. This is a very unique strategy that doesn't get the respect or the understanding sometimes because it's so unique. And we want to keep displaying that. Investors will expect to see that key wells report updated every 2 weeks, as we have been doing for the last many, many months. We'll be continuing with these webinars that show the key wells reports in more detail. And we're always happy to chat more about the technicalities of these certain wells, with any investors that want to reach out to us directly as well. So just to recap, a $12 million offering, of which 10 million is going into the ground, and targeting a 4.3x investment return in that 27-28 month time frame, which includes the shares and the warrant profit, and a complete fixing of the balance sheet that currently hampers us from moving forward. The current fixed cost on the corporation, along with the interest cost on the current debt we're carrying, just has not allowed us to move at the pace we want to, even though we have access to certain credit lines with vendors and ability to push forward. We've been very prudent of the existing debts on the company and the accounts payable burden, and really managing that through this while bringing wells online and demonstrating our strategy. And we're more excited actually to accelerate this strategy now. Just to remind investors that we're not just sitting here waiting for money to come in for us to do something. We still have a rig that runs as possible within certain cash flow. We're still getting the AP burdens cleaned up as possible. We're staying current on our debt interest payments, doing whatever we can to just keep the ball rolling upwards and onwards. And I think this is a very exciting opportunity for investors now to come in. We felt like we needed to raise more than the level of funds that we've been raising over the last 18-20 months in order to really fix this up and move forward aggressively. Summer has been a great time historically to allocate capital into service rigs, build single well batteries, get equipment on site, and move at a fast pace. And we've still got about 4 months of summer here yet to go in order to really push this profile forward, backstop by the production and PDP reserves increase by the end of 2028. And been having some really, really good conversations, given that we are one of the only junior companies left in the Canadian oil sector. 10, 15 years ago, there was 50, 100 companies of our size out there. Now there's 5 to 7, and of them, very few have this type of growth profile. It has not been easy. It has not been as fast as we would have wanted our production pace to be. And that's why we've come in here and taken a clear look at where we stand today, what we've proven out, and what we need to do in order to continue growing from here onwards. And with that, I thank everybody for joining us on this call here today, the sixth iteration. The recording of this will be on YouTube, as is the previous recordings. Any investors that aren't following us on LinkedIn, I would suggest you follow us and look at some of the micro content and additional content that we've been sharing on the LinkedIn page, along with our personal page. And then please have a look at the Key Wells report as well, which really proves our strategy out and displays that confidently and transparently. My email and Chris's email is here as well. For any personal questions, we are here in Calgary downtown. Happy to connect with investors for one-on-one presentations of our executive briefing or the full 70-page deck that we have accompanying this financing, and that's been presented to some of the more sophisticated investment banks and wealth advisors that we've been talking to as well. So with that, I will open the floor up here for questions, Sean, and yeah, we'll go from there.
Yeah, thanks, Shabam. Not too many questions. We've got three. Anyone else that wants to submit, please feel free to do so. First question is, with this capital being allocated towards these 140 targeted reactivations, how many can you do roughly per month?
Yeah, so this is a great question. The corporation over the past 6 to 8 months has gone through a couple of different raises, which have raised capital that's come in, and what we figured out is we haven't been able to move at the kinds of paces that we wanted to with that amount of capital. We really need to raise that slightly higher amount of capital in order to keep that constant pace of capital flowing into the ground while we continue to address some of the legacy payables and the normal course of business activities that the company needs money for. And so we currently see a cadence of about 1.5 million a month that can reasonably be spent. So of the 12 million that's going to come in, we're not going to go and just spend all 12 million in a month running 6 rigs, and all of a sudden you got this massive burden on the corporation of workload, and sort of you start to lose money, you start to see wells go down, and inefficiency at the end of the day. So we're going to be looking at a spend of about 1.5 million a month. The rest of the cash is going to sit there on the balance sheet, and then as our cash flows rise through the additional barrels, you're going to start to see that the net spending that we're doing starts to actually decrease because our cash flows are coming up while our spending stays at that same level as we go. The company does have the ability to accelerate even further for small periods of time. So if we see a good spell of 20 sunny days in a row coming up, we do have the ability to accelerate, especially in the summertime, and sort of we'll take that as we go. And depending on the results of the wells as well, and the ability of the field operations to manage these wells. So see about that 10 to 12 reactivations per month as our general cadence, with an ability to accelerate depending on the weather and availability of field operations. Chris, any thoughts?
Yeah, I would echo what you said there as well, Shabam. I mean, when we look at this, especially earlier on in the program, there's a combination of workovers and reactivations that are happening. The workovers, 1 to 2 days per rig to complete a lot of those jobs. The reactivations are taking a little bit longer, like those are maybe 2 to 3 days. And we've got a separate surface crew that goes around and puts in place the surface tanks and the recycle pumps and things like that that are required for those setups and those jobs. As we get into some of the nicer periods of time in the summer and early fall, I think we would aspire to have upwards of 3 rigs running, which is a bit aggressive, but can be managed for spurts of time, and that equates to at that pace upwards of well per day coming online, which is where we really get and support that aggressive growth profile that we're speaking about earlier on in the program. But that's I think it's unrealistic to assume that we can do that through across the 3-year period. Maybe we average about 2 rigs running kind of through that period of time, and adjusting for breakup and things like that. But those would be my thoughts.
Thanks, guys. Bit of a follow-up on that. It looks like currently, how many rigs do you have going? Are they focused on keeping old wells going, or are they bringing on new wells?
Yeah, so we ran a rig in May that completed 5 wells, primarily in the Cuthbert pool. There was 4 producers and 1 injector as part of that program. The new injector was part of the pipeline project that was completed in November. So that brought on 2 new injectors, and there was a third injector that had a packer failure, which we needed to address in order to really get that part of the pool going. And that's resulted in increased barrels, as is shown in our key wells report, with that increase into June coming up over the last couple of weeks. Uh, Currently, that rig is not running. It runs in spurts as wells require it. We're proud to say that no wells have gone down in loose land, especially our key wells. So that rig has not been running at current time. As we get paid through our previous month revenues, we'll plan to bring the rig back online to continue on its reactivation plan. We do have additional wells in Cuthbert that can be done on the pure workover side of things. But at current time, we're just waiting to see A, the financing, B, WTI pricing, where it goes, and that gives us the ability to run that rig from there onwards. People that are in Calgary know this as well. It has been one of our rainiest summers so far, early summer anyway, which has restricted the ability for that rig to be on site, given that we don't want to rut up the roads and just create more damage there at current time.
How does your team mitigate risks with reactivation candidates? This might have been touched on a little bit, but
Yeah, so we've got few ways to mitigate risk. One is that our engineering team moves well in advance of the rig, so we're not having, discussions on the well itself, hours before the rig shows up on site. We've discussed these wells extensively over the last 20 months, gone through the well logs, looking at additional perfs, what kind of sand we're going to get, reviewing the previous workover history. And then it's a matter of just execution. So we've done 17 of these projects now, and then 2 more this year, which brings the total to 19. Got a very clear view on what we're doing. And I want to remind investors, we're not here doing exploration. We're not drilling wells. We're not going out and doing high risk activities. These are sand cleanouts, hole in tubing changes, pump changes, rod repairs. These are jobs that are done hundreds of times a day across the oil patch with companies like Baytex, CNRL, Strathcona. We're not reinventing the wheel here on those kinds of jobs. The large majority why the reactivations cost more is because of the cost of the single well battery build. So putting that engine on site with a flow line, with valves, and then the drive head and the single well battery tank, that's what causes that job to be significantly higher cost than the workover, while still being way cheaper than drilling. It's not that we're doing anything different downhole. So when we talk about workovers and reactivations, they are essentially the same job other than a single well battery build, which is an on-surface activity, facilities engineering, and just crew truck work to put those in place. And we've got a very, very strong team out there that's built these and continues to build these for us at a very, very high quality of work there. So have not seen failures. We have not seen the wells freeze off in the wintertime because of the excellent quality of work done. We don't cheap out on the parts that we buy. We buy valves and spools that are going to last for many, many, many years, so that we're keeping the wells running, and we don't see this lack of reliability because we bought some cheap valve or something started leaking, as we go. So those will be some of the strategies that we use, and then bringing the wells online slowly. We're not interested in showing investors in the market these max rates and then, oh, the well went down in 14 days because it sanded in. Would rather show you that the well started off at 5, 6, 7 barrels a day. 3 months later, it's making 14, and 6 months later, it's making 20 barrels a day, as was displayed with many of our key wells, because that's the way to do it. The reason some of these wells are offline is because previous operators went in, tried to get maximum production out of the wells, and they were doing workovers every 30 days. We have the workover histories to prove that that's what they were doing. Well, we're not going to go that way. We want to show wells that have strong reliability and don't need workovers for many, many, many years. So it's not just about mitigating risk, it's about having that strong cash flow profile and production reliability that both us and investors like to see.
Fast forward, post 2028 period, when you pay down debt, will you wind up paying a dividend as did Hemisphere?
I can take this question here. And actually, this is something that we've spent a lot of time thinking about here. And because at the end of the 2028 period, there's a considerable build in cash. And so what we looking out want to be able to do is preserve optionality and so or flexibility so that we've got the ability to be able to generate the best return on every dollar that we look to spend at that point in time. So there's a few pragmatic pathways for the surplus cash. So one is organic development. There is additional development opportunity that exists in these fields in terms of that looks beyond the reactivation. And so there's infill opportunities, there's uphole perforation or heel perforation on some of our horizontals that were drilled previously that are provide attractive means of capital deployment. We've got considerable amount of EOR enhancements that we can look to deploy capital on in these fields. So really no shortage of organic development opportunities. But we also look out and have been are aware of other fields that are very proximal to us that are strategic fit, that we see as strategic acquisition opportunities that are complementary heavy oil properties, and allow us to go out and do the exact same thing. So reactivate existing wells in the same manner that we're doing right now. These are assets that we've already identified and that are really unloved by some of the larger majors and not getting capital allocation attention and the love that we would provide them. So those are kind of more on the development side of things. Of course, there's further enhancement that we can do on the balance sheet in terms of senior debt payoff. We want to be able to have that flexibility to be able to settle out senior debt if we so decide that that's directionally where we want to go. However, there are other opportunities to provide investor value in the form of dividends and buyback structures that are quite attractive. And I can see, to answer the next question that's in the Q&A, would we consider looking at dividends? And the reality is that all of our peers pay dividends of 6 to 10%, and are still able to grow their base production. And so I think that this is a little bit more my opinion, but we need to make sure that we're in line with our peers, but at the same time, with the capital efficiency of sub $10,000, we should be able to grow this organization at the same time. So a little bit all over there, but really coming back to this cash buildup provides us with considerable flexibility and optionality. We want to be able to preserve that through the plan.
You had mentioned being in talks with some lenders or banks. Can you provide any feedback how that has been so far?
Yeah, thanks, Sean. Just to add to Chris's point there, we are blessed here at Prospera with so many opportunities, and it was very important for us to go and prove that out over the 2025 and first half of 2026 timeframe to show investors, to show the market what can be done in that well-capitalized company that can move forward at the pace that we want to move forward. We're not seeing wells go down, having to spend money over and over on the same wells. And so being able to accelerate that plan is I think step number one. So having that ability to execute on that plan, and then as Chris mentioned, the optionality is in our favor. So we are blessed with two analog pools right next to us, the Strathcona Cactus Lake, and the Colville Tyne Pool that are both under polymer flood, upwards of 35 to 40% recovery. So we know that our reservoir is conducive to exactly that. Um, you know, Again, bring it back to the hemisphere story. They went and did the polymer flood, then they spent time paying back the debt to zero, and then they became a dividend player with now a Saskatchewan growth property. That is the playbook that's been proven by them. That is the playbook that we are trying to follow here, with strong execution and commodity prices that are more in our favor now, allowing us to do that a lot faster. And so that is exactly our plan. As we continue to grow and get more cash flow, there will be other opportunities that come up. But I think at the end of the day, the markets have been clear that we don't want to have as high a leverage profile as some of the juniors do, and we want to get dividends while we wait or enter this long-term structural oil bull market. And that's what the market's telling us today, and that's what we're building the company towards. If things change at that time and prices are a lot higher, well, that leads to a different kind of conversation. But at the end of the day, a company that's de-risked and has the ability to pay back its debt with strong low decline production that we aim to have should be able to pay a dividend in that 6 to 10% range and continue to do other initiatives. The wells and the quality of reservoir we have will allow us to do that. And it's just about executing as we get there. And we've proven that with some of the wells in 2025 we've done so far. And maybe I'll answer this question briefly. And then Chris, if you want to share some more thoughts. But our conversations so far have been really, really solid. After a long period of time, we're seeing some of the Canadian-based wealth managers and investment advisors be interested in the junior oil space, both for a variety of reasons. One, because there just isn't that many companies out there to invest in. They see the general market as sort of overvalued in many cases, wanting to invest in the hard assets again after a long period of software and tech investment, which still continues, but also wanting exposure to that hard asset base, the world's growing thirst for energy. And some of these investment advisors have made massive gains in the mining space over the last 18, 20 months, betting on gold, silver, and other types of mining plays. So they're looking to reallocate those gains now into the oil sector, which is traditionally what follows the other commodities after a period of time. So the conversations have been solid. We've been in discussions with various different sort of institutional grade wealth advisors. And just to remind investors, we did have an institutional grade wealth advisor come in with a seven-figure check on our February placement that we successfully closed of 3 million as well. So a lot of work has gone into this. We continue to have strong meetings booked and looking forward to close this here in the month of July, followed by execution of this program throughout the summer months and get to the targets that we need to get to. Chris?
When we set off on this raise, we talked about what was required to be able to address the balance sheet issues and grow the company to be able to provide an attractive return. And when we started talking about this, the conversation was around, okay, so there's a there's a marginal or incremental dollar that comes in from an investor. Where could that best be placed in the oil industry? And this was when the Strait of Hormuz was initially closed, and there were some speculative discussions around much higher pricing too. And the reality was that if you put that marginal dollar into multinational or even a large company here in Canada, your chances of getting a double or a triple on that multiple on the investment on capital is much less the likelihood of that happening is much less than if you put it into a smaller junior or micro cap company like Prospera. And so, it all boils down to risk profile, of course, and what investors' risk appetites look like. But that's kind of where it started for us. That is our value proposition here, is that we're able to provide through this financing, through this 3-year growth plans, we're able to provide an opportunity for investors to realize, a much larger multiple on their capital that's being invested.
Just one final one here, maybe on the macro outlook. It says, obviously, the heavy oil economics have been good with the Canadian dollar going lower, the diff staying in a good range, and WTI is holding up. If Iraq cannot bring their sour media crude online shortly, do you see heavy economics remaining for 2027?
Yeah, I mean, it's a great question. At the end of the day, Prospera has taken a bet, right? We have made a bet on conventional low decline heavy oil barrels, and that's, yes, backstopped by the Strait of Hormuz issue, the Iraqi barrels not coming online in a period of time, but this bet was taken long before that. We are betting on structural bull oil cycle that's got a higher floor and higher ceiling, backstopped by lower global inventories, lower global SPRs of sour crude, of heavy crude, the TMX pipeline expansion that took place, the Enbridge Line 3 that took place, allowing for increased egress out of the system here, and sort of lack of major sort of SAGD projects coming online, at least in the near term. So that is a structural bet that we took, you know, quite a while ago, and currently the dynamics further support that. So the heavy oil differentials have been very tight. The Canadian dollar has been very weak relative to the US dollar, giving us that increased dollars per barrel on a Canadian a barrel time frame, and our production has been very reliable and stable. So those three factors are exactly the factors that we're looking to accelerate our growth profile on. And the longer that this goes on, the more storage that global refiners build, the global demand continuing to rise. All of these factors are the reason that we see this extended structural oil bull market, and sort of us growing into that as it starts. These type of markets don't just occur, overnight. There is a phased process to it. And as many investors and listeners here know, the world has blown through a lot of spare inventory and barrels. The world has blown through the U.S. drilled uncompleted wells, its exploration reserves, and sort of brought on some of the bigger projects that were discovered 10, 15 years ago. And that pipeline is not as resilient and strong as it was then. So these are some of the factors that allow us to grow into this, protect us on the downside, but also take advantage of some of the upsides as we continue to grow here.
Awesome. Thanks, guys. That does it for questions. Like Shabam and Chris mentioned, their contact is on the last slide there, and we'll have this up this afternoon and on the website. So appreciate everyone's time. Thank you.